Welcome to TradeTheMBI.com. This is John. This report is for the 3rd of January. Well, no real surprise from our viewpoint. We expected weakness to continue because we still didn't have that magenta move over. Interestingly enough, though, we got the crossover of white back still above it, even though we have almost a full reset here of the magenta and yellow having dipped below, but still under weakness. And this was expected because we had what? Yes, we talked about it. The orange in between cyan and green is a continuation along with that continued dropping shakeout. No shock there. We haven't dipped below the red line, so we're not in a situation that is all that negative, and that's why it was pretty well controlled, and we hit the 23% pop back above it. Pretty clean from that standpoint. No real objections with any of that. What we were looking at was whether the NASDAQ would become congruent. Now, see, short-term buyers still being in there give us enough to have those pops and everything in between. And so you can see the dynamic of it is very clear when we look at it from a DOC standpoint. But we did get that orange dip coming down through. Now, if it were to pop back up, you would have much more extreme negative. We'd be expecting the zero at that particular stage. Even still, we're expecting continued weakness with the MBI white still leading the situation. So it hasn't been completely resolved, but that doesn't mean that there still isn't some positive within it, which is why you see these moves that take us back up. It's just not quite able to hold that support because of the overall negative readings. All pretty clean. And exactly what we would expect within the readings. The question we're going to have now at minus 56, we're getting close to that minus 60 level from an extreme standpoint, which would drive us below the red line, and then we would expect further decline. So those elements are all fairly clean within the general readings we've got here. We flip over to the Treasury market. It's not doing anything, and with the higher yields, you do have some draw from the market, and that's part of the disconnect here because there's some benefit, in particular those that believe that inflation is going to drop. They can see that higher yield as a benefit, and why not take it? The problem is this, because anyone who looks at oil and sees it doing what it's doing knows inflation is not stopping. It's going to record another pretty solid run probably in the first quarter of the year here. There's no way around it, and that's the driving force. And this is where we talked about that time delay before any of those actions that take place after January 20th. But with oil, yeah, I mean, nobody is surprised by this. I've been talking about the demise of the euro and the potential disaster facing the eurozone. It's going to get tough now. We're already below that 104 level, which was the previous sort of scary threshold, and now you've entered. Now we're down to the 102 range, and I don't even see that if oil fades off much, that the euro is going to be saved from this because the reality for the competition between the U.S. versus the euro is without question favoring the U.S., and I think that just puts added pressure. You add in the policies of the EU, and it's disaster over disaster. Looking at gold, though, it's going to be a little bit slow. It's going to be more methodical from a gold standpoint. Where you're going to see it is you'll probably see the much more advanced move, as we talked about before, and why Bitcoin is going to move disproportional to gold. Because it doesn't have some of the layered, entrenched, ability to limit its propagation, and that's relative to what we saw from the yield that gold had for the year versus where Bitcoin in that was, which was substantially higher. And of course, we saw Bitcoin make a pretty good sized move the other day, fading off just a little bit here, but still it's going to be pushing towards the higher realm of it, and that's just going to be a reflection of what inflation's doing. I would say that I would look for ETH to be more relative closer to gold simply because of the increased supply, just like gold has a constant increased supply. And it's relative to demand. Of course, there are other regulatory issues in that get in with crypto, and we don't have to go into that one again. We look at it right now in the European session, relatively positive after the day's session. And you can see that was mostly a lower one. It started pretty early. We had the little pops where they tried to, turn things around with the, call buying and that, but then, puts overtook it. But then again, even when the puts get too strong, you mean revert back up, and that's where it just kills all the gamma stuff, particularly going into weekend and definitely post holiday. I would expect at the beginning of next week we start getting back to more normal traders, everyone returning from holidays and that. Of course, here in Europe, you go all the way through the 6th, where they have the Befana, and of course, you have the Eastern Orthodox Church that has their holiday taking place coming up. So once everyone's done with all the holiday stuff, then they can get to the real serious grind of where things stand and what the prospects are. And I don't think they're as simple as, uh, yes, fine, there's optimism, at least from a regular person standpoint about where things are going. I don't know that that translates to the market. And I think that's an important distinction between the two. So keep that in mind. But as always, anything relevant, I'll put on the Skype chat. Have a good one. Trade well.